Let's dive right in. Imagine you're monitoring your portfolio one day and suddenly everything becomes highly volatile. What causes this fluctuation? Stock prices experience significant fluctuations due to underlying economic principles, which often result in unpredictable patterns. Think about the last big market drop or spike. Remember that stomach-churning feeling as those numbers flickered up and down. Now picture this. Every single share represents a piece of ownership in a real company, entitling the shareholder to a portion of its future earnings. But how do investors decide what those companies' future earnings are worth? First, let's talk about supply and demand. When more people want to buy stocks than sell them, stock prices rise. Conversely, when more people want to sell stocks than buy them, stock prices fall. This principle is simple enough, but why do these shifts occur so suddenly? Here's a common misconception. Markets are rational places where smart people always make well-informed decisions. In reality, emotions like fear and greed can lead to irrational behavior, causing prices to fluctuate dramatically. Now let's look at some real numbers. Suppose you have a company that earns $1 per share every year. If investors expect the same earnings in the next year and are willing to pay 10 times those earnings, then each share is worth $10. But what if expectations change? What if investors start thinking the company will earn only 50 cents next year instead of $1? The value of each share would likely drop to around $5, reflecting the lower expected earnings. Suddenly, people are willing to pay 5 times the new expected earnings per share, which means each share could be valued at $5 if the previous expected earnings were $1 per share. That's a significant shift based solely on a change in market sentiment. So why does market sentiment change so quickly? Two main factors are at play: new information and investor emotions. First, information. News events like economic reports, company earnings, or even tweets from influential figures can swing expectations dramatically. A positive report might make investors think the company will earn more next year, say $2 instead of $1, pushing share prices up if they're willing to pay a higher multiple for that new earning expectation. But here's the kicker. Once a piece of news is out there, everyone has access to it eventually. However, not all information travels at the same speed or gets fully digested by market participants simultaneously. Some individuals get the information first and act on it before others react, causing sudden shifts in demand and supply, which can lead to volatility in stock prices. Now let's talk about emotions. Fear and greed are powerful forces that can override rational thinking. During periods of economic uncertainty or crisis, fear often causes investors to sell off their stocks rapidly, regardless of the price, driving down share values. Conversely, when optimism prevails, even high prices may seem justified as more people join in, pushing stock prices further up. Let's look at an example from history. In 2008, news of bank failures began circulating slowly but steadily. Initially, only some investors recognized the risks and sold their shares. As word spread more widely, larger groups joined in selling, leading to massive panic and sharp price declines as sellers outnumbered buyers for several days. In contrast, during the late 1990s, particularly around 1999, people were optimistic about tech companies' future prospects. Even if those companies weren't earning any money yet, investors poured in eagerly, driving up share prices to sky-high levels before they eventually fell again. Another factor is short-term thinking versus long-term planning. Many investors focus on daily or weekly price movements instead of looking at the bigger picture, which often leads to volatile market swings as individuals chase quick profits rather than consistent growth. For instance, day traders who buy and sell stocks multiple times a day often lose money over time because they're focusing on short-term price fluctuations rather than fundamental company performance. By contrast, long-term investors tend to perform better because they can ride out the ups and downs of the market, benefiting from overall economic growth trends. Now let's dig into some math. Say you have an investment that grows by 10% one year but drops by 5% the next. Your final value after 2 years isn't just a flat zero gain, it's actually down slightly to about 94.5% of your original investment. This is because even small losses can erase earlier gains if they come too soon. The same principle applies in reverse. Steady, consistent growth typically outperforms erratic, high-risk strategies over the long term. For example, over 30 years, an index fund with an average annual return of about 7% will generally far outpace a portfolio filled with volatile day trading bets. But here's where things get interesting. Volatility isn't always bad. It can provide opportunities for informed investors to buy when prices are low and sell when prices are high if they have the patience and discipline to navigate market fluctuations. Think of it like a sale at your favorite store. If an item you want is heavily discounted because everyone else thinks it's not worth buying, you might snap up the deal before others catch on. In the stock market, finding those rare moments when shares are undervalued can potentially lead to significant gains later on. Now back to our earlier example, how do expectations shift so suddenly? Partly due to herd mentality, investors often follow what others are doing rather than thinking independently. If a prominent investor like Warren Buffett buys into a company heavily, many other investors might follow suit, driving up the price even if they don't fully understand why. This can create feedback loops where initial shifts trigger further reactions that continue to amplify each other until the market corrects itself. It's like a snowball rolling downhill. It grows larger and accelerates as it continues to roll. Another key factor is leverage. Borrowing money to invest can amplify both potential gains and potential losses. When markets rise, leveraging can magnify returns. However, when markets fall, it can lead to significant losses because the borrowed funds must be repaid even as investment values decline. This risk explains why even seasoned investors tend to avoid high-risk strategies unless they have a well-thought-out plan for managing downturns. The use of leverage can amplify small price movements, turning them into significant financial losses if not managed carefully. Now let's address another common myth, the idea that active management beats passive investing. Studies show this is often false. Most actively managed mutual funds underperform index funds over time, even after fees are factored in. This happens because fund managers must consistently outperform the market to justify their high fees, which requires constant buying and selling to try to time the market correctly. But timing the market is notoriously difficult. Imagine you're trying to catch a falling knife. Just as it starts dropping, you jump out of the way to avoid getting cut. That's what active managers aim to do with stocks, predict when prices will begin to fall so they can sell before losses occur. Yet most fail at this because stock price movements are influenced by too many unpredictable factors. Passive investing through index funds involves buying and holding a broad selection of stocks that represent a specific market or segment. Over the long term, these funds often outperform actively managed ones because they incur lower fees and experience fewer transaction costs associated with frequent trading. But here's an important point: being passive isn't risk-free. Market downturns still impact your investments, so it involves riding out the volatility rather than attempting to avoid every dip with complex strategies that often fail to perform as expected. Another factor contributing to volatility is the role of central banks like the Federal Reserve. When they adjust interest rates or inject liquidity into financial markets, these actions can significantly impact stock prices and influence investor behavior. For instance, during economic downturns, lowering interest rates can make borrowing cheaper for companies and consumers, potentially boosting spending and investment. As a result, more money may flow into the stock market as investors seek opportunities, which can help lift stock prices. But if central banks raise interest rates to combat inflation, it has the opposite effect on stock markets by making loans more expensive and reducing the availability of funds for investment. As a result, fewer investors can afford to buy stocks at higher borrowing costs, which tends to cause stock prices to fall. These market movements can have significant effects on entire economies, influencing factors such as consumer spending and business investment decisions, which in turn can impact stock prices substantially. Now let's look at one last factor, the role of technology in amplifying volatility. The rise of algorithmic trading and high-frequency trading platforms enables extremely fast transactions, which can intensify price fluctuations even more. Imagine thousands of computers programmed to buy or sell stocks based on real-time data analysis. When a sudden piece of news triggers these algorithms, it can cause rapid spikes or drops as millions of trades execute within milliseconds, leading to increased stock market volatility. This accelerates how quickly changes ripple through markets and can amplify short-term volatility, which may subside as human traders adjust to the new information. So now we've covered several key factors: supply and demand, information flow, emotional reactions, leverage risks, and technological influences. How do these elements combine to affect stock market volatility? The most important takeaway is to focus on long-term stability over short-term market fluctuations. By consistently investing in diversified index funds, you can navigate volatility while continuing to grow your wealth. Remember the dot-com bubble in the late 1990s or the financial crisis of 2008? Both events illustrated that attempting to time the market perfectly is extremely difficult and can lead to significant losses if investors miss out on the subsequent recoveries following downturns. Instead of chasing every hot tip or fearing each dip, stick to a consistent investment plan. Regularly rebalance your portfolio and keep fees low. Doing so helps you build real wealth over time without getting caught up in the daily market noise that drives short-term volatility. Consistent growth usually beats erratic fluctuations in the stock market over time. This is educational and historical, not financial advice.